All right. With that, let's get started here. Today we have with us Aram and Jeff. And just so people know, this is a club fund speaking session. So they're going to actually be presenting on an investment opportunity that they have that I've already vetted and already gone through. And I think it's a great opportunity. And I'm going to steal the last 10 minutes, maybe a little less if I can, of your presentation time in order to say why I think this investment fits well into the fund. It actually fits very nicely as a second fund purchase. And so I'll take a few minutes at the end. And RM and Jeff, can you introduce yourselves and your company?
Yeah, absolutely. Thanks, Daniel. I'm RM Sarkissian, and with me is Jeff Block. We're
Hello,
from
everyone.
LaCreme. We are
Sorry.
from LREM Partners. We'll get into a little bit about a bio about ourselves, but a lot like you guys have a tech background. So when you say Intel, we know what Intel means. And so our journeys have been spending a lot of time, meaningful careers in tech. That led us to doing, frankly, what a lot of you guys are doing, investing in alternative assets, or what I would call private money types of deals. That led us to we're data nerds though, so basically we're putting together our own models, doing all this sort of stuff, and that led friends and family to say, well, why don't you guys start doing some of these deals yourself? You're pretty into it. So that was the aha moment for us about 6 years ago. We started to do that, and our goal is really it's been an investor focused journey, right? Because that's the hat we started wearing. That's the hat we still wear. And so we're always thinking about it from the investor's vantage point and what can we bring that's differentiated in the marketplace. So we're asset class agnostic. We find things and we work with partners always who are fantastic at what they do, and we craft really amazing opportunities. And we don't do a lot of them, but when we do, there are things that we find really, really compelling. So I love what Daniel's doing. This forum speaks to us. And thanks. Without Jeff, anything to add to that? I don't want to.
No, yeah, I mean, look, we invest a lot more than we do deals. So, when we are looking to do deals, we're really looking at what are those macro trends going forward, and how can we take advantage of those, and then we're always looking for something that's differentiated. There's some things that there's other people that can focus in some areas because that's what they specialize in. So we usually try to look at something that's really has a lot going for it if we look forward 5, 10, even 15 years, and then just try to come up with a differentiated offering. So yeah, this one will be very interesting.
Yeah, yeah. Okay, well, thank you. So I'm going to jump right into it. And just to be sensitive for time, I'm going to move a little bit quickly so that we give enough time for Daniel to talk about his thoughts and also a little bit about how this dovetails into the fund. So this is the LCP Austin Development Fund 25 LLC. Kind of a mouthful, but that's where you are. So let's start. Executive summary. So what is this? So have kind of reinvented single family housing building, and we're doing this using modular construction. And so our build partner in this and friend has been doing this in Austin for about 3 years now, kind of perfecting the model and the craft, both modular building, but also in the Austin market itself. So got a 3-year track record. We'll talk more about that later, but there's a lot of proof positive about what's already happened there. The opportunity itself, really, it's the modular housing, but also dovetailing with that is that Austin has passed some new zoning reforms where you can build up to 3 homes per site within Austin proper. So what that means is you can get, they're suffering with the same housing concerns that a lot of metro areas are. And they're combating that by allowing this new legislation to get more density on these lots. And that creates this amazing opportunity for us that really makes the economics pretty impressive. And this modular is really well suited for that. So we're building infill lots in Austin proper and building up to 3 homes per site. We're using the prefabricated modular construction. The advantage is there. You can build in about half the time. We'll show you what that looks like later. And it's much lower cost, both in terms of the raw cost and the carrying cost of doing that. And in the end, there's really significant investor advantages. So in this fund, we're offering a very high pref. I'll let Daniel talk about the financial terms, but essentially it's up to 22% in the kind of the aggregated fund type model that Daniel's put it together here. So there are no fund fees in the fund, and it's a pretty short lockup, and it's a pretty quick path to to cash flows and relatively high cash flows. So we like it a lot, and hope you do too. Okay, a little bit about the sponsor team. There's a lot of words here. I'm sure Daniel will make this deck and things available to you, so won't read through all of it. We told you a little bit about Jeff and I. Again, just deep professional backgrounds and investor backgrounds and really business acumen. We've been running businesses for as long as I can remember. So we're pretty good at this stuff. And again, we partner with people that we that we trusted, that we've invested with. And David Lauber is one of them. So he is our partner in this particular activity. He's very successful in his own right as a developer and also as a brokerage company and some other things. And he's in Austin, and he's the one that sort of perfected this 3-year arc of building modular in Austin. And when we saw this legislation coming, we started talking middle of last year about this. The legislation actually went into place February of this year, and we are making hay while the sun shines. So this is the sponsor team. It's the 3 of us. Let's talk a little bit about the strategy. So fundamentally, it's a buy, build, sell, right? So we're taking advantage of the modular construction, the zoning, and all of that to buy infill lots in high value neighborhoods. So we're not way out in way out in Round Rock or something like that. We're really in Austin center, Austin City, and not necessarily downtown, but the city limits. And we're buying infill lots, and some of these might be bare lots. Some of them might have an old home on them, but we're buying those lots, tearing them down, scraping them, and then we're building new up to 3 homes per lot, and very quickly, and then we're selling them. And you'll see when we get to the comps that we're able to sell those at a pretty good price. And what we're building are very kind of what we would call attainable housing. So we're not building, this isn't like low income housing, but this also isn't super high end housing where these are custom homes or anything. They're very attainable, very median kind of home price for those neighborhoods. So they're the kind of homes that are in high demand. So that's the strategy. It's not a long-term hold. It's selling, and all those proceeds really wind up into the fund, which is why we're able to pay these prefs we're able to pay. Prefabricated modular. So the advantages, it's just significant cost advantage, about half the cost, faster time to completion. We can prop up these things very quickly, and you'll see why when I'll show you a little bit of a Gantt chart later comparing the two methods, conventional build, stick build, to modular. Modern architecture. So they're beautiful. I mean, I will tell you, one of the things I personally had to get over was the idea of modular construction. For me, modular construction, what I grew up with, was ugly. It was, it was ugly, just plain and simple, very utilitarian in style. And what you find now is modular's come a long way. It's quite beautiful. They don't look. Somebody asked, do these look like modular homes? Well, they look like homes, right? Just they use a modular technique for building. So pretty impressive. And we'll show you some pictures, and we've got other videos and things that if anybody's interested, we can certainly share. And then ESG. So ESG. So it's an ancillary benefit, I would say, but at the end of the day, look, we're on the site less time. We are building these in a factory setting, so there's just less waste, less emission. We're not impacting the city as much. It's a cleaner, easier, simpler, more efficient way to build. So all of these things are advantages that we can employ. This chart kind of shows you both the cost and the timelines graphically. So the black is the traditional construction. So in terms of cost, and this will vary, of course, market to market, but when you look here in the Austin market, traditional construction running about $300 a square foot to build homes. The initial cost on this, when David first rolled out the model, was around $250. So still a significant improvement on cost. But as we've gotten more efficient at this, it's now down to about $200 per square foot. So quite a steep discount on the cost per square foot. The other big one is the months to complete, the timeline to complete this. So traditional, you could be looking at an 18-month arc, start to finish, from the time you get the land to the time you're done. Initially, this was down to 8 months, which already is massive improvement. Now you can get as low as 4 months from the time you get the lot to the time you're up and selling the homes. Now, we're not underwriting it 4 months. We're actually underwriting it more like 9 months. But are nominally, 6 months is about right to go from something that's totally,
And Aram, if you don't mind me adding something there,
yeah.
Remember, we also do have the sales cycle as well. So there's time associated with getting the property listed and then actually going through that sales process. So that's always going to be on the back end of that.
Yeah. So that might add another month or two. So that's why I'm saying maybe 6 months or so is probably more reasonable. So to actually dispose of the property, sell the property off. But huge advantage. And time is money. So remember, when you're building something, you have the carrying cost of the loan. So being able to shorten that really is, it adds to the overall cost savings. All right. And another thing, I mentioned proof. So we're already doing, so there's the 3-year history of building modular in Austin. But there's also a history of being able to, we've started this already, building on these 3 per lot plans. So this is a graphic. You can see you probably can't see it too well, but it's shows you 3 lots that are contiguous in this case. And each of those has 3 homes built on it. And in some cases, it's a couple of townhomes together on one side of the street. On the other, it's a larger single-family home. And so we kind of go with whatever the lot is giving us in terms of, we got to find lots that kind of meet our buy box, and then we'll configure the homes in a way that makes sense for that area. But the point being with this slide is we're doing it on the right. You see the modular construction, how they're dropped in with the crane and off they go. And this first project, homes will be ready to sell back half of the year here. Pretty amazing stuff. It moves super fast, and we've already moved this through Austin's permitting and all of that, which was almost non-existent in terms of how fast that moves under the new legislation. So no impediment to moving forward with the plan. It's a proven model in that, again, I'll just reiterate, 3 years of doing this. You see this beautiful picture. That is a modular home with the garage and the deck and all this stuff. So these are beautiful homes at the end of the day. There's about $20 million worth of property that's kind of has been finished or is already in the pipeline working. So, there is proof there. And about 40 people, when we say trained prefab construction workers, it's actually, so there's David's core team, right? He's got his own business, of course, but then beyond that, he's got about 3 different general contractor teams that over these years he has trained up on how to install this and put it together. And now they're very efficient at this. And we've got a big enough ground crew that we can be at different sites and doing different things. And that, continues to expand. But there's essentially a proven system in place to do this in the Austin market.
Hey, Aram, we've got 2 questions right now that I think would fit in well. The first one, the second one is from Mohammed, and I don't know if you're going to be showing that video that you have of your construction process, but he's asking, could you explain one more time what modular construction is?
Okay, yeah. So basically, what we have with modular construction is. Okay, so think about it this way. Think about Legos. I think about my kids with Legos. So modular construction has these finished modules. So you might have, a 50-foot by 20 feet. So you've got maybe a house has 5 modules make up the entire house. So the house is built and delivered in sections. So these sections are built in a factory and they're totally finished out, right? Here, in fact, let's go back to this slide. You see each of these pieces that are being lowered with a crane on this slide. I don't know if you guys can see that. The right-hand side picture. That's a module being dropped into place. So maybe you got 3, 4, 5 of these, depending on the size of the house, that you're stacking and configuring, and one might be perpendicular to the other, but you're just arranging these fundamental building blocks of these modular homes where all the plumbing, everything's done. They just connect up, right? And when they're connected up, you have the finished home. So they already come kind of ready to go, depending on the design, and then you just sort of stitch them together, do the final finishing, so to speak, and you're done. So sorry.
Jay is asking who actually builds these modules.
Great question. Company's called BuiltWise. That we have there, and I'll get to. There's a slide on that. Maybe when we get to that slide, I can talk to you about their history and things. But yeah, there's a factory that builds them, and that's part of the supply chain that's been, vetted and worked through. And
one more question from Glenn too. When buying these lots, are you subdividing them into 3 sublots and selling the land and house to each?
Yes, ostensibly, yeah. So what's happened is it's not like a condo model or anything. This new zoning provides that these can be sold individually now to 3 separate buyers. There's 3 separate addresses. It's not like an ADU or anything like that. they really become three separate tax IDs and can be sold as such. So yeah,
we're getting a lot of
divided.
questions now. I'm going to let you continue
Okay.
with your presentation for a little bit, but
Yeah,
Hey,
questions are
Daniel,
rolling in.
if
Yeah.
it makes sense, I can certainly share that video or even another picture. So just let us know if I think Aram's going to cover some of this, but we can certainly share that if you think that helps.
Yeah, if you have a link to the video,
I'll put it in the
I
chat.
have the link to the video. I'd be happy to drop it in the chat if you want me to.
Sure. Anybody can, yeah, you can share anything we've shared. It's not a problem at all. And again, we're always welcome to, for those interested, we can have a Q&A session, Daniel, if you want to set that up.
I'm getting somebody who says the link to the presentation that I just put in isn't working. Is anybody else having that problem? Is anybody else not able to access it?
To the video?
You know what? I'm happy to put a link in there if that helps. And then in the meantime, you can double check your link. What would you like, Daniel?
Go ahead. I just double checked mine. I'm able to access it, but I don't know what that means for other people.
Yeah, why don't you go ahead? It's a Google Drive link, I think. I'm going to keep moving.
Yeah, you keep moving, and I'll take care of everything else here.
Sure
the link works. You just have to request access.
Okay, let me just make sure permissions are okay, and I can fix those if there's an issue.
Yeah, it's actually on my drive that I sent the link to, so I'll fix it.
Okay, so I'm going to keep moving, guys. So that's the modular. I hope that was a long way around answering that question, but I hope that helps. And again, we're going to move pretty quickly here, but we're happy to answer all these questions because it does take a lot to fully digest it. But this is what it is, and that's what it winds up being in the end. Okay, so it's nothing if you can't sell the homes, right? So so this just speaks to the comps. So these are proven sales results. So the stuff in green are the actual units that have been sold. The stuff in what's a sampling of the units that have been sold, and then the stuff in yellow, are the relative comps. So you can see the couple things on this chart I'll point out. So one is you go back from February 22 to February 24. So there's comps that have happened throughout these couple of years, right? So it's not like this is 3-year-old data or something. It's really it continues to happen. The other that's interesting is you look at the price, the absolute price of the home and the price per square foot. We're fetching a pretty solid price per square foot. So it's not like you have to sell these at a discount because they're modular or anything. There's not even a disclosure that, well, this is a modular home. It is modularly built, but there's nothing about it that isn't a home. It insures like a home, all the rest of it. So this is really just kind of a proof point, and this was important for us as we were thinking through the journey of making sure that those sales were there and achievable, and we believe they are. And then, we're building beautiful homes at the end of the day. In fact, there's a video Jeff has of the construction. There's one of walking through the home, big windows. I mean, what's kind of nice is, modern day design sensibilities are actually quite a bit better. So you have high ceilings, you have things with space that designers do today with light and space to make things kind of better than my home that was built in 1961 in California that frankly, I wish they designed it a little differently, but it is what it is. So modern design sensibilities and materials are all in play here. Okay, so let's get into just a little bit about housing because that's an important backdrop to all of this. So I would say the takeaway is single-family housing has remained really strong. It's a very market-dependent thing, of course, but home prices are still up despite the rate hikes that we've seen, and I think there's a lot of talk about rates going the other way, coming back down. So one could argue that single-family house prices would go up again, but who knows? But really, they're strong. Is what this is the takeaway. There's a few big reasons for this. One is people aren't selling homes that have locked in low rates. So anybody that refied in 20 or 21 at sub 3% on their mortgage is sitting pretty, and you can't sell out of that house. It's never worth selling at that finance rate, right? So there's a low supply of so those people aren't selling. There's a low supply of new homes. And in fact, ever since the Great Recession, builders have not kept up with home building to meet the supply. So we've been undersupplying the market just about every year since 2008. And so that leaves us with a dearth of homes. You hear about this housing crisis. Well, that's caused by this. And there's not a lot of economic incentives. A lot of builders are gun shy still to get into those markets and build. So it's just it's a supply demand thing at the end of the day. And I think for the foreseeable future, that's going to be real. Austin in particular, it's just a great metro area. It's growing. It's projected to grow through by this chart in 28, 13% growth, 13 near the 14% growth. So it's, as metros go, it's a growing metro. It's got a lot of diversity in terms of, next slide, jobs. So you're looking at job growth and payroll growth and all of that. And then as far as best cities to live in, it makes the chart number 2, right? It's a pretty phenomenal place for those of you that have spent any time there. It's a lot of fun. It's not a one-trick pony kind of town. There's a lot of tech that people talk about going there. It's a big music town. It's a pretty well-diversified metro with a lot to offer. And it's really got, we believe, nice tailwinds. And then, you got to think about, well, how do the jobs line up with the housing supply? And this chart, shows you, well, look, even with the job growth, the housing supply has not met the demand. And so if that curve or that gap keeps widening, it should point to, sustained housing prices being, relatively high. So all of this stuff is sort of the backdrop that gives us a lot of confidence in the fund's ability to perform well. So let's talk a little bit about prefab housing. So again, reduced labor cost. I'm going to move pretty quick, but reduced labor cost is one big one. The material efficiency, we talked a little bit about that. Another one is just weather impact. So, by the way, Jeff and I are not new to development. So we have 3 build-to-rent communities. 2 of them were ground-up projects where we took dirt and created large build-to-rent communities in Houston. I can tell you that weather's real, like environmental factors real. You get delays. I mean, those projects are set to do very, very well, but at the end of the day, they're not struggles that you don't have to work through. So, you minimize that. This is built in an indoor factory. It's delivered essentially finished as an enclosed module, and then you're just stitching them together at the site. So that's a huge advantage. The other is this duality of design flexibility plus standardization. So the modules give us this standardization, right? These standardized Lego building blocks, but you do have design flexibility. As with a set of Legos, you can still make a lot of different things. Same is true here. You can configure those modules to stack, to be orthogonal, to be whatever you want, and you can finish them out differently with different sinks, different this, different that, depending on the neighborhood, depending on the aesthetic. So you get a lot of both flexibility, but still the fundamental building block is standardized in a way where it helps you and reduces cost and gives you efficiencies. This is a cool chart. I love this chart on the left that shows you the traditional build versus the prefab modular. And so this is where the time saving really, really pays off. So let's start at time 0. So at time 0, what happens? You purchase property. Okay, well, in the conventional model, the site, you have to plan, go to the city, get the design reviews, all that kind of stuff. That takes we've got about 5 months for all of that stuff to happen. Well, in the modular world, what happens is in Texas, particularly, these module designs, the designs themselves, these standardized blocks, those designs have been stamped, right, approved at the state level, which means we can go anywhere in Texas with this design and it's already approved from like an engineering and structural standpoint. So those approvals are already in place. So all we're really doing with the city is saying, hey, we're going to put this here, and they're going to care about the setbacks and a few other little things, but that's about it. And keep in mind that in Austin, they've fast-tracked this. They love this, right? Because they're the ones that passed the legislation to get it going in the first place. So they're even more in a hurry to get those permits passed for this kind of building. So it's really a win-win for us. So that planning and design becomes kind of a non-existent thing in the prefab modular space. Then next you've got like foundation. Well, foundations, similar kind of time frame. It's a little faster in our model, but you have the foundations. Now in our case, we can do the foundations and in parallel with the manufacturing of the modules. So we say, okay, we got this is the design we're going to go with. The factory's building out those modules or finishing them out while we are finishing up the foundation. You kind of run those things in parallel. They get delivered to the site, and then you do the on-site installation, and you're done, right? In the traditional model, you do the foundation, God forbid there's weather, blah, 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 blah. Then you get to the on-site construction, the framing guy's kid had a whatever, it just takes a long time. So the on-site building, first you got to do this, then you got to do, everything becomes serial, and it just adds time and to the process. And the overrun there's always overrun. So from experience, and we can tell you that it's about 50% faster. So it's a pretty, and again, time is money in the construction business. And then there was some questions really about the supply chain. So where is it? So BuiltWise is the company. They've been doing this about 40 years. Of course, they've evolved, right, as a company, getting better and better at this. There is two factories. There's one in, the original one is in, South Carolina, and they've been delivering all the material to date. There's a new factory that's just come up. There's a picture I think Jeff has, we can show later maybe, of the new factory in New Mexico. This was just a site visit out there a couple of weeks ago. We have some pictures. So anyway, that's going to reduce the shipping time from 3 days to 1 day. Gives us another factory within the BuiltWise world to choose from. It's a little bit of redundancy there, frankly, from a modular supply chain standpoint. But this is a supply chain that's well vetted. David has got a partnership with them to ensure that we deliver this stuff. They can produce about 500 modular units a year at this new factory. So we don't think there's any kind of supply issue there. So again, it was a good question to ask, which is, well, where do these things come from? That's all been worked out, vetted. It's all like part of the system. Now, God forbid we want to change ponies. We could use a different one. BuiltWise was the one that was selected by David after a lot of diligence, but there are others that do this. This is not the only company on earth that does it. I believe modular will be a significant way homes are built going forward for all the reasons we described, but we think we're early to this process. And again, we're going to make hay while the sun shines and do the best we can as kind of an early adopter of this in Austin. Okay, so I've got a couple more slides and then I'll be turning it over to Daniel. But on the financials, so the deployment strategy of the fund. So a quick moment. So the fund lives here. So of course, Daniel's, the alternative investing fund would invest in the Austin Development Fund. But taking the Austin Development Fund, that fund is essentially would be investing in each of these projects as the sole investor in each project, essentially. So David would then, he builds out each project, and then that the profits from that flow back to the fund, right? The fund doesn't take on any debt. The debt is held at the project level. And is personally guaranteed by David. So there's a lot of skin in the game there. And we basically, all those profits flow back to the fund. So that's kind of the way it works. But in each of these projects, we are planning for homes that are in this 500 to 800K range, which I don't know where you're all calling in from, but for Austin, that's a pretty attainable, affordable kind of range in the Austin proper area. These are in infill lots, so we're not building like one big 200 unit DR Horton style community where, we're going to have absorption issues or something. We're kind of, tactically and strategically coming into neighborhoods on specific lots so we can turn these quickly. 6-month hold period roughly per project. And that allows the ability to move pretty quickly and redeploy capital if we need to, and about 3 to 5 year fund duration. And a lot of that's going to depend on, what's happening, like what's going on with the macros. And if I believe that maybe 3 years from now, the city of Austin says, we're going to issue a few less permits on this, we're happy with what we've done, or there may be a whole bunch of new builders that enter the market and kind of crowd it out, and the profits aren't as strong. And so maybe we dismantle everything in 3 years. Maybe we go 4, maybe we go 5, maybe we go 10. But our target range is, we think 3 to 5 years is probably right for this. So just a couple quick examples. You want to know kind of what's in the fund itself. So when I talk about the projects and I say that the fund funds each project individually, this is an example of what a project would look like that the fund would support. So, the way it works is David comes to us with stuff and we go, yeah, let's look at that. Does this one work? And as a check and balance, Jeff and I are the managers of the fund. David, is remunerated by the fund later after investors, like we participate in the profits, but David is not a manager of the fund. So Jeff and I have the say of whether or not the project gets green lighted for the fund, so that, David is the kind of as the developer role, stays in that lane, so to speak. And we get to sort of cross-check and validate. And we have said, hey, this one doesn't quite fit the buy box of the fund. And he's like, great, I'll just do that one myself, because that's what he was doing anyway, doing some things on his own. And we basically amplified his success. So I just wanted to make that quick comment. But what you see here on the box to the left, there is basic metrics and assumptions. So, number of lots. In this case, there was 2 lots. Those 2 lots are able to do 3 homes per lot, so 6 total houses. That's a home size of about 1664 in terms of the square foot per home. So we're building out just under 10,000 square feet of home, of total home. So the middle group, the middle table rather, shows you kind of the sources and uses. So you're looking at land cost, 670 for those two lots, a little bit of closing cost. The construction cost, of course, is the biggest piece, right? You're going to buy the modules, all of that stuff. So there's nearly 2 million there. So your all-in cost is just under 2.7 million. Okay, then from there we go to financing. So we can finance these with pretty high leverage loans. They're construction loans, they're short term. Interest rate is high, probably lower now, a little bit, but roughly, let's call it 10, 11, 12, even 15%. Frankly, I would almost say it doesn't matter because it's a small enough cost that it doesn't move the needle. Even if you were to double the interest rate, you could stomach it on these projects. So, but this is the interest rate from the bank. So the loan winds up being, in this case, about 2.37. Then you've got some loan fees and then the interest. Now, the interest that we're carrying here, we're saying it's for 240 days, which is closer to 9 months than the 6 months. If we do better than this, which we anticipate we would, this is just our way of being a little conservative to give ourselves some padding there. That's that number. And then you've got prop tax, insurance, utilities. So this is while we're holding the property, we've got that stuff to pay for. So your total all in is just under 3 million. So the equity needed for that is 690. So we put in 690. So what that says is the fund is going to write a check to the project for 690. So, okay, we're funding that project at 690. Now in the end, the project returns, the price per unit is about 660. So that gets you just under 4 million of total revenue. You've got cost of sale. Cost of sale is going to, real estate agents, right? That are going to sell the house. And then you get your net sales proceeds of about 1.35. That 1.35 on the 690 you put in says you're at an equity multiple of close to 2, right? So not a bad investment. So what this says is at the fund level, we can write a check for X and we can get back 2X in 6 to 9 months. Hey, that's a pretty good investment. So if the fund will continue to do those investments, that you can see that there's plenty of meat on the bone to pay investors who are obviously in the first position with these very, very high prefs, and then anything else is back end on us. Now, if we don't perform quite as well, it's us, the sponsors, that wind up getting the haircut, right? We'd get completely zeroed out before anybody else would see any challenge or any problem with those preferred returns. So it's pretty well de-risked from an investor standpoint, and that's why we like it.
Hey, LREM, are you open to some questions right now, or do you want to continue?
Yeah, let's do it. Because after this slide, I was going to turn over to you. I'll leave this slide up. This was the second example, which is the same as the first, basically just a different set of properties. But yeah, I'll leave it there so people can kind of look at that and digest it while we're taking questions. Sure.
All right. Glenn is asking, can you talk about the target audience, their income levels, and their typical avenues for financing?
Yeah, it's a good question. I think, look, this is it's going to be a range. I think we're going to see some cash buyers in this. I think we're going to see some young families. We're going to see retirees. We're going to see all kinds of people in this. I think this is not, and I mean, it's not exactly what you'd call like entry level housing, but I don't know. In Austin, it could be.
Like, in other words, if you wanted to really go, you do the same thing like you do in the Bay Area, right? You see people, if you really want to lower your price, you go out to Tracy, or you keep going farther and farther out. But these are neighborhoods that are in Austin where people want to live. And then I will say there's a range of neighborhoods, right? Some of the neighborhoods are more expensive. Some of them are a little less expensive. It's still Austin though. So in Austin proper, things are relatively expensive. So yeah, there's different people that will live in these different neighborhoods, but there are people that want to live in Austin. They work in Austin for the most part. And these are the people that are buying these houses.
All right, Jeff, I'm glad you mentioned the neighborhood, because that actually was going to be my next question. What are these neighborhoods like? But if you have anything to add, you can. Otherwise, I'll go to the next question.
Sure, go ahead.
All right. So the next question is about the property taxes. How are modular homes different than traditional homes when it comes to appraisals and property taxes?
Yeah, they're identical. So at the end of the day, you're building a house.
In fact, let me share an image while you're talking, Aram.
Yeah, let me stop. I'll stop sharing the screen then.
Because these
And
look like stick-built construction, but in a factory.
yeah,
And there is a question about, maybe a robust version. So while you're talking, Aram, let
yeah.
me
So
just share.
basically, there's no change. The property tax is taxed as a home. You don't get a benefit, but you don't get a penalty. It's a house. They're going to tax you like they would tax any home. So you're going to have conventional property tax, and then the the other part of that was the yeah, here we go. What was the other half of the question? One was property tax. One was, what was the other one? Sorry, I don't want to make sure I answer the question. There's property tax, but there was a second half to that, I thought.
And appraisals.
Oh, appraisals. Yeah, they appraise like homes, right? Someone's going to come in and they're going to say it's a 2,000 square foot home. They're not going to say, well, yeah, but it's,
maybe what really, at least the way I think about it, is you're building single family homes. It's just that your method of construction is one that's lowering costs and lowering the time to market. But at the end, the product is a single family home.
Yeah, well stated. That's perfectly well stated. Yeah.
So this looks like stick-built construction, but it's done in a factory. And there are elements, we had a big, I was typing this in the chat, but since we're talking here, I'll just say it here. So we had a bigger investor fairly recently visit Austin and tour a lot of these houses with us, and then the new Roswell, New Mexico factory. That's what this is right here. And he kept commenting on, so first of all, you didn't realize they were modular homes, like when you went in them. So unless you knew it and were trying to look for clues, you didn't know that they were just nice homes. But then he kept commenting on a lot of aspects of, wow, these are very sturdy, these are very robust, just in terms of the weight of the doors, right? He kept bringing it up. He's like, wow, so it was little things, but he was noticing that. Then he went to the factory and saw some of the construction methods and identified several different areas and trusses and, just in the way that, they're kind of secured to the base and the subfloor and, maybe more robust construction methods. And remember, these will be transported, to the construction site. So think of them as maybe a little more heavy duty of a site stick built type construction methodology.
Yeah. All right. Next question. What's the demand percentage for modular versus home built, site built homes?
It's a great question. I think it's the same kind of answer. So I think so I guess what I'm saying is there's no difference. So nobody, like when I don't think people come and say, like, I wouldn't say like, well, I'm interested in buying a DR Horton home, not a Pulte home. So like, it's kind of, they're just homes.
So this is not a mobile home, right? When you're talking to your agent and you're like, okay, we're looking in this price range in this neighborhood, they're taking you to see houses and you're like, wow, I really like this one. They're not saying this one is, this is a different version of a house, right? I mean, it's just, it's a house. It's a house. It's just constructed in the factory in large modules and then assembled and finished on site.
Yeah, I mean, I think this is the future of housing, period. Yeah. Like, I think eventually this is the way things are going to be built because people have to find efficient ways to house the world. So they're going to get better at this, and they're going to. Anyway,
Manjo is asking if there's a home in Austin that's being sold at $600K, how much will it cost to build that type of home with your end-to-end solution? So if I could rephrase that a little bit, he's asking about your cost to final, sell value.
Yeah. So, well, I mean, if I go back, let me just go back to that slide.
You did present that. It's just those weren't packages of 6 homes or 9 homes, but
yeah. So here's an example of, in fact, here's a 600K home. So there's 6 houses, 600K. So what's our cost? You could take this cost, our total build cost. Let's just in round numbers, if that's 3 million, right? Divided by 6, it's $500,000, I guess, to build a home that goes for 660.
All right, and then we have a question also about: are you renting any of these? Or are they all going to be sold?
The plan is to sell them all, right? If there's like a incredible market collapse and all credit freezes and you can't buy homes anymore and it's outlawed in Austin, then yeah, we'll rent them. But I mean, the world would have to end. The
world would have to
plan,
end, yeah.
That's not your
the
business plan.
Yeah, the plan of
Right.
record is to build to sell them. You can rent them, but you're not going to rent you might sort of be at some
It's kind of
break
like Bay Area, right? You could rent your home if the purpose is to hang on to your home, but there's a way better return you can get than probably renting a $3 million home for not nearly enough money. Now, having said that, David has taken some of these homes and used them for short-term rentals for periods of time just to try that out. And I know there's at least one of the homes. In fact, we can share this video of me just kind of walking through, one of these homes and kind of just going through and looking at the floor plan and the finishes and all of that. But I know that they're under a negotiation right now for that home, and I believe that the potential buyer of that home is going to use them as short-term rentals. So yeah, it's you can certainly do that, but the purpose of the fund, of course, is buy, build, sell.
Okay, we have a couple of questions. There was one question about the schools in the areas that you're building in. But I think you answered that when you said these are being built in a variety of markets.
That's right. And it's just like anything else, right? I think you saw in some of those comps we showed, there may be some neighborhoods that are, 350 a square foot, and there's going to be some neighborhoods that are 650 a square foot and in between. And so everything is priced relative to the location and the neighborhood. And then the idea for us is to try to kind of try to be around that median, because I will say this, David's actually done a number of things in Austin. So he certainly was leveraging the 2 per lot zoning previously, where you would build an ADU of say 1,100 square feet and then maybe a 1,700, 3.2. But he's also gone into much higher end neighborhoods and used modular to build luxury. And it's really incredible because these are luxury homes that might be selling for, a couple of million in Austin. And so you maybe take the finishes up another level or two, and you're going to build one home on a lot, but there's a lot of things that you can do with it, and it just really depends on the neighborhoods. In the case of the fund, we're really focusing on kind of those median priced homes, and that also gives us the biggest margin of safety, right? If things do change in the market a little bit, that's a pretty good place to be, right? Because there's a lot of transactions, and there's a solid floor underneath us. So that's kind of where we're operating the fund in that sort of a buy box.
Yeah,
Eugene?
and then one thing. Yeah, sorry. Go ahead.
I was going to start another question.
Yeah, I was going to add to that. Just the other thing to think about is part of the reason we've shifted. So David was building these luxury homes because he was trying to maximize the value per lot, right? We now, after these lot splits were made available in Austin, the economics totally changes, and it makes sense to do these, and that's got all the advantages that Jeff just described. So sorry, you were saying, Daniel?
Eugenio is asking, since the cost of sales is lower than the competition, does your investment strategy include lowering the price to lower the holding cost? So basically, how does your innovation and construction affect your end price?
So I think, well, we could lower the end cost a bit, but we don't want to leave money on the table, so to speak. So I think we have cushion, and so if we need to, we could still lower. We have enough price. We have price cushion there that we could edge down on the price. But I think the goal is, I mean, look, I think we're investing to make money, so the goal is to maximize the profits. But we believe we have comfortable margin there, that there is some flexibility.
So look, there's a sales strategy in every, and we work with different agents in different neighborhoods that knows those. But if we know that, days on market are 35 days in this neighborhood, well, then we're going to try to sell the house at where it's comping out at and get that price. If you get to the 35 days and you didn't get as many offers, or they were a little soft, well, yeah, then maybe you will lower the price, right, to go ahead and move the house, and there's plenty of margin to do that. But I think the idea is you try to get the market price within, kind of the market, within kind of those market metrics, right?
Well, here's a way to think about it. Right? The holding cost isn't very high, right? So you've got that holding cost. That's basically, I don't know, it's a couple grand, few grand per home per month, right? So if you're going to give up $10,000, that's 3 months of holding cost on that house, maybe. So because all you've got is the financing cost of that carrying cost, so the fractional part of that of carrying cost. So by the way, if we really wanted to, we could technically we could refi once it's built, and do more perm debt on it. But that's not our intention. Our intention is sell. We think we have enough margin there, and we think that it's a balancing act between moving the units and getting a price that's acceptable to the fund.
Oh, I was going to ask the question about HOAs, but Jeff just answered it. And Eugenio asked this question: how long is the construction loan term? And I know you mentioned you could just refi it when it's built, but go ahead.
Yeah, these are generally, they're generally just pretty open-ended. I mean, they're usually 12 to 24 months, something like that. Nobody usually they're not 6 months loans, so not going to expire anytime soon. And David has a brokerage business, so like his ability to go get loans is just not a problem. So I don't think it's an issue. I think money.
We're much faster than stick built, right? So stick built, right there. Those are open for much longer than we keep them open. We underwrite them for 9 months just to give ourselves room. But
yeah, by the way, we're paying a premium for these loans. So these loans, you can get this money all day long. If you're willing to pay 10, 11, 12% for money, there's a lot of loans out there. So we're not worried about our ability to finance this.
All right. Glenn is asking, can you walk the fund returns, timing, lockup, etc.? I think that's a good lead into some of the things that I wanted to mention with relationship to the Alternative Investing Club Fund, the AICF fund. And then I'll open it back up for questions. We do have quite a few questions here, and we could go past the 1 o'clock point if people want to stay on. But in terms of the fund, this is why I like this, and just to always go back to the fund's fundamental goal. And the fundamental goal of the fund is to find 7 to 10 different diversified alternative passive investing strategies. And the first thing that we invested in, and actually we're still accepting funds to place in this, is DLP Capital. They were running a debt fund. And the reason why they were the very first thing to go into the fund was because they had a 90-day lockup period, which meant that the first investment going into the fund would provide a lot of liquidity to the fund. Because if somebody wanted to exit the fund would be able to sell off some of those shares and provide exit capital. And so that provides what that provides for the investor in the fund is the ability to move in and out of the fund, which is something that a lot of syndications that we've had in the past have not been able to offer. The fund, the club fund itself has a 3-year lockup period. So my goal as the fund manager is to take on investments initially that are below that 3-year period so that we can meet that goal. And so DLP Capital gives a 9 to 11% return, and they have great liquidity metrics, and they're a large $1 billion fund, which I consider to be too large to fail. So and they have a consistent track record. So they were a good starting point. Money that goes into the fund will actually be immediately, if there's no project we're currently looking at the fund investing in, money that goes into the fund will just be immediately put into DLP Capital, because then we're getting the better 9 to 11% return rate, and it can be liquidated fairly quickly to go into some of these other types of investments, such as manufactured housing. So why I think this is a good second investment in the fund is, first of all, it has intrinsic advantages within the market, right? You've got a lower cost, you've got a lower time to market, and you're serving, I think, a societal good in providing housing that's available at lower costs, and you're putting into the market the means to produce housing at, at a lower cost, which is needed within our current housing prices. So it helps methods that will address housing problems in our country. So I like it from the social benefit. I like it from the point of view of, and the next thing that I like about it is, I don't know if you caught, do you have your pref value up here?
Yeah, are
So
you
the
seeing
the
the
preferred,
screen?
yeah,
I'm
the
sorry.
preferred returns are right here. If you put in 50,000, it's a 13% preferred return. If you put 100 in, it's 15, and a million, it's 18. And then there are kickers if they're put in by certain time periods. So our fund's goal is to put $1 million in, and get that 18% with the 2% kicker. And
Actually,
so
18 plus 4,
I'm
actually.
sorry, 4% kicker. Yes. So if we can hit that target, what that means is that we're getting a very strongly cash flowing asset within the fund. And cash flow and liquidity are the two primary things that need to go into the fund first, so that we can take on, in the future, longer term projects that might have, high overall returns, but lower liquidities and cash flows. So the first two things that I want to put into the fund are liquidity and cash flowing. Um, I love the I love the turnaround time in that each of these houses are individual projects. So it's not just one project that's going forward. You've got several projects that are going forward, and they're all paying out too. And you've already started this. One of the drawbacks, and I will say this with this particular one, as opposed to a DLP Capital or something, is obviously, I mean, you're working with well-established construction people in the Austin area who know the Austin market well, but it is a different than a DLP Capital where they're $1 billion fund. You're not $1 billion fund, but you are an established player within the Austin market. And so that's where the fund gives flexibility to the different types of investments that we put in it. I'm going to personally gravitate more towards those really large funds that are just giving consistent benefits. And then when I see smaller deals that have either a unique business model or intrinsic advantages within the market, and are giving a better return, that's when you can make investments in those, balancing them with the larger players. So that is why I like that within the alternative investing club fund. And of course, if you are interested in potentially putting money into this through the club fund, I am just going to collect people's names and
Do you want
email
me to,
addresses, phone
do
numbers,
you
and
want me
here's
to,
the link.
yeah, do
I'm
you
going
want
to
me
drop it
to,
in the chat.
okay, I also have, did you want me to go to this for the,
Oh yeah, yeah. So the link I just dropped in the chat is the same as that QR code there.
okay.
So let's open it up to any questions for why I think it's good to be in the fund. And then I'll go back and address specific questions to the manufactured home fund. All right. Boy, a whole bunch came in and I wasn't watching here. So since these are infill lots, can there be HOA stipulations?
I think, we're not buying lots that have HOA stipulations, so we're avoiding that. Conceivably, you could buy a number of lots that are contiguous and condoify them or something. That's not our intent. Our intent is not to do that. We're not buying anything that's. Remember, we're buying something
And
that
again,
was
we're
not.
selling anyway. So if HOA, so we're not doing things that have HOAs, but even if we were, then that would be factored into the pricing in those neighborhoods and the desirability.
Yeah, yeah. I hope that answers it.
I just saw Shruti, can you talk to me? Your Gmail inbox is full and I can't send messages to you. So I know you've been emailing me telling you to do that. I can't do that.
Oh, okay. Yeah, I added my work email as well. So
Okay. Thank you.
yeah.
I just wanted to let you know you told me to use your personal. I've been trying and I can't because it's
Okay. Okay. Got it.
Okay.
Yeah. Yeah.
Any other questions? What's the timing to invest? So we're immediately accepting funds into the club fund. So the steps there would be that you'd put money into the club fund, and the club is going to try to go for one of these larger amounts so that we can get a better overall return. So we're accepting funds right now.
Yeah, so we'd be happy for everyone to invest in the club fund.
Yeah, and by the way, the club fund can then is there's no delay for the club fund to invest in our fund because our fund is open and active. It's
That's right.
Projects in construction, so there's no the money will get deployed.
All right. Anybody who would like to stay on and ask questions, feel free to do so. For those of you who want to drop off, let's take ourselves off mute and just thank Aram and Jeff for coming in and speaking to us today.
Hey, thanks, guys.
Thank you.
Thank you very much.
Thank you all. Our pleasure, guys.
Thank you. Thank you for being a great group here.
Okay.
Have a wonderful 3-day weekend.
Yeah, wish you all a good 3-day weekend.
And anybody who wants to ask questions, I'm just going to invite you to take yourself off mute and go ahead and ask them.
Yeah, now we're hanging out.
Wait, okay. Put your hand up. Use the little hand up icon and I'll call.
I had a question earlier. How does the modular home compare with the site built on safety, disaster damage, the strength, the age of the houses?
Yeah, well, I mean, so let's start with the age of the houses. The age of the house is brand new, so it's being built in a. So I think one of the things to consider is Jeff showed you the picture of the stick-built home, right? So, or I'm sorry, the factory. So the factory is kind of it's building using 2x4s and normal building materials. It's just doing them in a factory setting. So it's doing them. So it's using the right materials. So it's just as safe. It's just as secure. It's built to code. It's doing all that stuff.
And there's foundations that go in right on site, and those are installed onto the foundation, right?
Yeah, so I mean, the way I'm thinking about it, so it's interesting. You asked a really interesting question. It was a thing I had to get over. It took me about a year. So I had to go from modular. I'm thinking of this as some, lesser product that's being delivered, because that's what I grew up with, right? Some ramshackle thing. It's not a shed, right? It's really it's less about what is the modular construction versus it's more about how it's built versus what's being built. What's being built is a home in every possible way, using the things you'd use to build a home. It's foundations, it's studs, it's all this other stuff, but you're building it in a factory in a controlled environment. And so I would argue that from a safety and quality standpoint, you're getting more consistent quality because it's coming off the factory line. So how they do the QC there and all that is way different than maybe the guy that's doing the framing on site. Look, I've been to construction sites. There's garbage everywhere, and there's people coming and going.
We have construction sites.
Yeah, I'm like, is that guy? And then the stuff gets left there and it gets rained on, and I'm like, oh man, is that going to screw up the site? So in a way, I think it's a more controlled. The deliverable is a more controlled kind of deliverable, but then there's nothing in the end. What you're getting is a home in all the ways you'd think about a home. So I think it's a great question. It brings the sort of biases we all have, which are there's this inherent bias about, well, how does the modular compare to the house? Well, it's a house, so it compares exactly, right? I hope that answers the question.
Yeah, it did. So is there any reason a homeowner would prefer a site built versus, or is it equal in all respects?
I think if you were building a very large custom home that had all kinds of bizarre angles to it or something, you're probably going to build it using some some custom builder. But I think that there shouldn't be. I mean, if you look at what a lot of the major big large home builders do, they build these massive sites of homes, and there's nothing special about those homes. In fact, I would argue in some cases, depending on the builder, they may be using cheap, inferior ways to do it.
Yeah, these are, I would say, much nicer than a lot of those.
Okay.
Yeah.
Okay.
Yeah.
And sorry, last question. Say if I take a particular area in Texas, and if in the area where you're building the modular built homes, and compare the percentage of the homes which are modular built and non-modular built, how does that look like? And do you have any projections on the trends?
Yeah, so I couldn't tell you. So I think well, if you look today, you're going to find very few modular homes by percentage wise. This is a relatively new thing. In fact, we think we're very early to this. So you're not going to. By the way, you may not know. So I mean, it's not like when you go look at when you go look at an address in Zillow or something, it's not going to say this is a modular home. So you're not going to even know.
This is not like a mobile home, right?
Yeah, yeah.
You know, so you just don't know, right? When you go look at homes and you want to buy one, your realtor is not saying, okay, now I want to prepare you. This is a modular home, right? It's a home.
It's a home. That's
all right. So Pravin has a question here. Hopefully I think we communicated the point there. So
yeah.
Pravin, why don't you go ahead and take yourself off mute? I'm sorry, Praveen.
Yeah, Praveen. Hey, thank you. This is a really nice concept. I like it. I have a few questions on the terms themselves. First question on the fund term, 3 to 5 years. What happens at the end of the 3 years? I'm trying to understand.
So I don't know if Daniel, you want to answer that relative to
your
fund
so the 3 years refers specifically to the Alternative Investing Club Fund. So the fund itself has a 3-year lock-in period. And the reason why that is because a lot of syndications will have like a 5 to 7 or a 4 to 6 year lockup period. My goal here was to bring that down a little bit so that investors had more opportunity to move in and out of these private placement investments. And so some of them are going to be lower lockup times, like, for instance, this fund has a lower lockup time, and DLP Capital has a lower one. But some of them are going to be higher lockup times. I'm currently working with an industrial group right now, and I have already gone through the process, and I'm okaying them to be one of the future club fund speakers, and they have a 6-year lockup period. So our fund has to balance the low lockup periods and the higher lockup periods. And 3 is kind of a middle ground. So what happens after a 3-year period is you have the option of, selling your shares or selling your units rather, your stake in the club fund.
Right.
And so you just write, you provide an email or a written communication that yes, you want to sell. And then I go and make a determination on whether we have the liquidity to sell or not, which is why I want to bring in highly liquid things first. And then we would liquidate those shares and send you your money. Okay. So in the fund itself gets a new price on a quarterly basis. So we actually do an evaluation of the holdings of the fund, and we change the price on a quarterly basis. So each quarter there's going to be a new price, and the lockup period is 3 years.
I see. And then what happens after the 5 years? Is that
it's an evergreen fund, so it just continues on until you want to sell.
I see.
Or until we take an executive action and say, okay, we're closing down the fund, which at the moment, we're bringing in potential partners in the future that'll have 6-year periods. So it'll be a long-lived fund, and it'll be evergreen until you decide to sell.
Sure. And then I have another question on the bonus preferred return. On, for example, class A2, there is a 2% preferred return. What does that mean? It's like 15% per annual preferred return plus 2% or over a period of. So it's basically coming out to be 17% per year.
Yeah, I mean, that's right. So basically at the fund level, at the Austin fund level, at 100K, it's 15 plus 2. At $1 million, which is where kind of Daniel's targeting for the fund, it's 18 plus 4. So it's that much more. So the fund return that, in other words, going through the fund, the Alternative Investing Club Fund, and if that check is written at that amount, then there's this much larger benefit for the entirety of the fund. So there's a lot of, that's the group benefit, right? That much larger investment.
Got it.
Thank you. And I'll let Vindhya go ahead and take yourself off mute and ask your question.
That was perfect. Hey, Daniel. So I have a couple of questions. Yes, that's right. It's India with a V. And you got it perfectly right. I had a couple of questions, and the first one's for you, Daniel. I'm sure you talked about this already, but I didn't catch it. Is there like are you expecting like a minimum investment in the club fund?
Yeah, the minimum investment is $25K.
Oh, 25K. Oh, so it's the same. Okay. All right. And the second question is for you, Aram or Jeff. Are you guys also like going to be in charge of you're going to selling the home after it's built? What's the end state here? Or are you going to hand it off to someone else to do selling?
No, so we're involved we're involved the entire way. So we take our responsibility there very seriously. So we meet with David weekly at least. We have a formal weekly meeting. We go through everything we are, current state, like what's going on with new law procurement, deal review, what's going on with the status of the homes. We also issue, just so everybody is clear, we will issue to any investor, including the fund, right? We would issue a monthly, we're already doing it on this fund, a monthly statement that says, here's the project status, all of that. And that will include selling. So when we come to sale, we'll look at that and say, okay, what's the best path for sale? What's the right price point? Who's the right agent to do this? And we'll be involved in it every step of the way. We will approve or not approve offers, right? I mean, like all of that is part of our managerial responsibility, frankly. So until this is built and sold and fully executed, we're involved every step of the way.
Okay, great. Yeah, thank you.
All right, and now I'm going to go to Mr. Quadruple C. or Mrs.
Yes.
I'm not sure.
Yeah. So my question was, obviously, I've heard in the past that we could use our IRA funds for investing in the alternative. So
Yes, you can. The club fund actually accepts everything you can think of: trusts, family offices, earned,
Bitcoin.
Actually, we don't accept Bitcoin. You're right. Not everything.
So do I need to like withdraw from the IRA and then put it in? Like, what is the process? Is there some documentation available for me to help, or somebody can tell me like what is the process?
Well, okay. So IRAs, and just to give a quick overview there, what you need is a self-directed IRA. If you have an Intel IRA or Intel retirement fund account, Intel controls the investments that go into it, and so those can't be used, unfortunately. You need to have a self-directed one, and if that's the case, you'll have a custodian for your self-directed one, and you just go to them and say you want to withdraw the funds, or write a check or whatever you want to do.
There's a lot of them, and they all have their process, right, of the paperwork you fill out to do that.
Jeff and I deal with that a lot because we have a lot of investors that come in that way. So if somebody wants to have Daniel probably has a wealth of information too, but if anybody needs just offline discussion on how that whole world
we're always happy to help, right? Happy to help the fund as well. So
Yep. Thank you.
And our club uses a third-party administrator called NAV Consulting, and they make the process fairly easy, I think.
Oh, great.
Okay, so NAV Consulting, that's what I need.
Yeah.
Okay. Thank you, Daniel. I'm Chetali again.
Any other
thanks for the
questions?
good questions? I saw a couple hands up, unless they're.
Feel free just to speak if you have more. I know the hands that are up right now are from people who have already asked their question, I think.
Okay.
Here's what is the cost to invest in directly minimum, like without going to the fund, or is this opportunity only exclusively through the fund?
Go ahead.
Well,
50,000 if you.
Yeah, 50,000 if you come to us directly. So look, the idea here is we are here to support Daniel and the fund, and so if you have $1 million check and then do it yourself, right? It makes sense. But the advantage is Daniel's got a low minimum, and that low minimum. So for 25 grand, you're essentially getting the same terms as $1 million investor potentially. So that's pretty significant. So if you were, if you're coming in directly, you certainly could do that. But just know that there's some economies of scale that Daniel's offering, and I think they're pretty compelling. So you want to weigh that, but.
Just a quick question to people. I've had a couple of people said they can't access the Google form that I put in there. Is that a Intel company computer problem?
No.
Okay.
Did you want me to hold back up the? I can just reshare. Let me do that while we're talking here. Let me reshare my screen and put back up the QR code. Why don't you guys try to? If anybody's looking for the form, I believe this QR code will get you there.
That's Daniel's one? No.
That's mine, yeah.
Yes, it is.
I just created a Google So if you go to NAV Consulting, honestly, they're a third-party consulting group. They're a little more bureaucratic in terms of sending out emails that may be missed and things like that. I just wanted to capture names and email addresses so I could follow up and then point you at NAV Consulting. So that's what this quick Google form is. If you want to go directly to the club fund landing page, I'm going to throw that into the chat right now too. It's with NAV Consulting. And you can sign up there as well.
Yeah, and I think, oh yeah, and then this was the other link you had. Sorry, Daniel, I don't know if this is also that same form, I believe, but just in typed out form. I may be wrong, but.
So anybody who can't access the form, feel free to email me. You all know my email address, daniel@goodsamaritancapital.com, or as I'm transitioning over to now, daniel@alternativeinvestingclub.com. Either one of those will get to me. All right. Any other questions? Well, then, with that, thank you, Aram and Jeff, for coming in and speaking to us today. Congratulations. I usually cut this meeting off right at 1 o'clock. So you may have the longest running meeting that we've had in our club so far.
I feel so. Yeah, we feel honored.
Yes, that's
well, thanks.
true. That is true.
Look, we thank you guys for your time. I think the biggest investment you can always make is your time, and thank you for spending some of that with us. If anybody has any other questions, Daniel, we're certainly open to. If you have another Q&A you want to pull together with some people that are interested, we're happy to do it. We're here to support you guys in the fund and your investing journeys. Everybody have a great 3-day weekend. Thank you very much for having us.
Thanks you very much
for coming in, and thanks, Daniel, for having them in.
Yep.
Thank you.
Thank you very much.
Bye, guys. Thanks so much.
SS is asking, when do you stop accepting funds? And I think you're going to be continually accepting since new projects are coming up on a regular basis. It's ongoing as of this point.
Yeah, there's two layers to that question. One is your fund, right? So at the Alternative Investing Club fund level, there may be an end date for that. At our level within the Austin Fund, I see us continuing to accept funds for at least the next year. I don't know, 6 months. So it's a $25 million total. So it depends on if in 6 months we hit 25K, then I have to create a new fund anyway, or redo the paperwork. So, but I think what we'll probably wind up doing is we're kind of pacing this a little bit. It'll be a little bit dependent on how the market does and all of that, but it's an open fund for now.
So we're matching that up with our acquisition pipeline, and right now the acquisition pipeline is extremely strong. So we anticipate keep raising here. But at some point, if it weakens a little bit, we may, it's a possibility we may not take funds for a quarter and then reopen. But I think for the time being, we have a very strong acquisition.
Yeah, we don't want to be stuck with too much dead money, right? But
from the fund's point of view, we want to hit the target in order to get that 4% extra kicker. So I'm looking to raise $1 million by the end of the year.
Okay, got it.
Daniel, this is Gopal. How are you?
Hi, Gopal.
Hey, question. So can I put in the funds in multiple phases? Meaning, like, I can start with 25K and keep on adding.
I'm actually hoping that's what most people will do.
At different points, I have something coming up. So I'm thinking, we're putting it in multiple phases. So you said you reevaluate the values every quarter.
Yep.
Right. So the basis might be different for the second fund, which comes after that evaluation, correct?
That is true. Yes, it'll be reevaluated each quarter, and we'll put out an official, statement of value. And then for that quarter, that's the price.
Got it. Yeah. Thank you.
All right.
What's the current price right now?
It's $25,000 per unit. So $25,000 is the initial price of the fund, and it's currently at the initial price.
Okay. Thanks.
Yeah. All right. I guess with that, I will end the meeting here. Have a great weekend, everyone.
Thanks again, everyone.
Thanks, everyone.
Thank you, Daniel, for having us.